In 1928, a $40 investment in Coca-Cola stock would have made you a millionaire today. But what if I told you there are stocks right now that could potentially replicate that astronomical growth in just a decade? Welcome to the Century Club, where we dive deep into companies that have been battered by the market, but might just have the potential to skyrocket. I'm Felix, your guide through this financial jungle, and today we are exploring stocks that might just happen to replicate the path of Tesla and Nvidia in the last decade. But before you think I've gone balmy, let me be clear. I'm not promising you 100x returns. That's as rare as my golden retriever Winston solving differential equations. But what we are doing is analyzing these beaten down stocks to see if they have the makings of a phoenix rising from the ashes. But speaking of rising, our teaching portfolio has seen quite the ascent this year. We're up almost 90% this year, almost at $30,000, which would double our 30K portfolio. If you fancy learning our methods, or maybe you're just curious or dubious, come and join me and ask me the difficult questions, and I'll teach you our exact strategies that we've used to achieve these results in just a couple of hours a week. Pop over to the link in the description down below. Throughout this video, we're going to be looking at stocks that faced challenges. We explore their business model, their recent performance and potential catalysts for growth. We will also be discussing the risks and hurdles each company faces. Remember, we're not making predictions here. We're dissecting the data, examining the financials, and considering market trends to uncover possible opportunities. Think of it as financial archaeology. We're digging through layers of market data, hoping to unearth valuable insights. Will we find hidden treasure or fool's gold? Let's find out together. Let's start our exploration with Organogenesis Holdings, a name I had to pronounce a couple of times before it came out half right. A company that's been through more ups and downs than a heart monitor in A&E. Trading at a mere $2.50, penny stock, oh dear, this stock has seen better days. But it could be the medical miracle Wall Street's been waiting for. Organogenesis is in the business of regenerative medicine. Essentially, they're the body's repair shop. What's their main focus? Advanced wound care and surgical products. Think of them as the pit crew for your body's Grand Prix. Now let's dissect their financials. Winston has, of course, helped by chewing up the income statement, but we've managed to piece it back together. Organogenesis over the past year has been bleeding red ink. They posted a net loss of 16 million. Not exactly the picture of health we were hoping for. However, we need to look at the full patient here. Their revenue has been growing steadily from like 270 million in 2019 to now about 448 million, 11% growth year on year. Pretty healthy, not terrible for a sort of medical slow lane, but analysts are predicting profitability this year. And that's pretty breakthrough stuff, because when these stocks become profitable, it tends to open up a whole new universe of investors who don't want to look at penny stocks that are not making any money. So what's their secret weapon here? Well, they've got a fairly diverse product portfolio. Diabetic foot ulcers to knee osteoarthritis. They're casting a fairly wide net. And that's obviously a good thing to do because it's a risky space to be in. But let's not put on our rose-tinted spectacles for these guys. They have some serious challenges. Medical device market is pretty crowded. They're up against some giants with some deeper pockets and broader reach. And their stock's been on an absolute downward spiral that would make even the most stoic investor uneasy. They were trading at $22 in 2021. They're now at $2.50. Whoa. So this is a hidden gem or a value trap? Well, when stuff's down 90% and I don't fully understand the fundamentals, I would say value trap. Because one wrong move and these guys are basically out of business. They're not making any money yet. Operating margins are 6%, profit margins negative, and their free cash flow is only 22 million. Positive, but only 22 million. So if they come out of this, I'd like to see them back at like $5 or $10, and that's probably when I get interested. I'm going to say no to this particular dip here. Now let's move on to our next stock. It's a company that's been trying to breathe new life into the pharmaceutical industry. They're all about insulin delivery, mankind corporation. A name that might sound a little bit German, which is why I read it out like it was German, but they're actually a pharmaceutical company that is American. And they're in the business of making life easier for diabetics. Their flagship product, a freezer, which sounds like an Italian dessert, doesn't it? Cruel. It's essentially insulin you can inhale. Imagine that. No more needles, just a quick puff and you are sorted. It's like they're taking the spoonful of sugar concept and turned it into a breath of insulin. I know now I am being cruel with the sugar. Okay, but before we get too excited about it, let's look at the stock under the microscope. First, the good news. Mankind's revenue has been on a steady climb. They've gone from 65 million revenue in 2024 to almost 248 million in the last 12 months. That's pretty impressive growth. And they're doing that while reducing their cash burn. And that's, of course, important for these guys. So they lost $11 million in the last 12 months. But 3 years ago, that was like 80 million. So they're kind of on the right track. Not bad, essentially, for selling air. But yeah, they're still posting losses, like most of these early stage companies would. So it's an intriguing story. Now, they're also looking to leverage their inhalation technology to develop treatments for stuff like pulmonary arterial hypertension and other conditions. So they're trying to use that sort of delivery method in a different way, which is kind of interesting. So they're trying to turn that inhaler into a Swiss Army knife for drug pushers, which is clever, but of course, again, not without its challenges. So there's, of course, competition. The diabetes market is pretty crowded, more crowded than a London tube, which is the underground that they have. Not that I've been on one in quite a long time, got to be honest about that. But what about the stock price? It's a little volatile. It was trading at like $50 in 2014. Right now, it's trading at $5 and a bit as I'm recording this. Now, a lot of these kind of stocks are coming a little bit back to life just from the expectation of lower interest rates, which means the market is going to be a little less cruel to the non-profitable tech innovation type stocks. So it could be something in this. I like that they are moving towards break even. I mean, actually, the last trailing 12 months, they've actually made some profitable, some positive net income, 11 million. It was minus 11 million in the last financial year, but it's plus 11 million in the last 12 months. So this is looking quite interesting. This is looking quite interesting. So I'm quite liking this one. Of course, the allocation and risk management and all that stuff is key with these guys because it's super, super risky. And you could argue that these kind of stocks maybe should never be listed. So how do you do that? My rule of thumb is typically put an amount that's so small in it that if it disappears, you're not going to notice it. But if it improves by, say, 10x or 20x, then, well, you're going to notice it. So, percent, 0.5% or something like that is probably a good thing as a good rule of thumb for growth stocks generally, especially if they're not yet profitable. Now, let's move on to another stock here. It's a company that's been making waves in a rather different industries. This is MarketWise, a company that's seen more ups and downs than a roller coaster. Currently trading at about 80 cents. Quite the tumble. What's with the penny stocks today, you might wonder? Well, look, they're essentially a financial advisor in your pocket. They sort of provide research software tools for, investors. So why are they not making any headways? Well, let's look at the financials. That's always what we do. Just look at the financials. And the first clue is, well, it's revenue. It's been dropping from 500 million plus in 2022 to now 430 million for the last 12 months. And that's not exactly wonderful. Now, are there any bright spots in this data? Well, they're making money still. And they're continuously reducing their debt burdens, but they're also issuing shares, quite a lot of shares, something like 7 million shares a year more, which is pretty staggering dilution of something like 18, 20% a year. Not exactly the kind of thing we want to see as a long-term investor. So why does it make the list? Well, they recently went through a shakeup. Their leadership has changed. The founder, Porter Stansbury, has taken the helm as CEO. So the captain is returned to a ship in stormy seas, and Porter Stansbury is sort of your direct marketing, financial data whiz kit out there. But MarketWise does face some serious challenges. So the whole financial advice market is pretty crowded, and there are some big players in this. And when a stock price takes a nosedive like this, It makes a lot of people nervous. It was trading at $14. Now it's trading at 80 cents, which is a free fall of rather epic proportions. So is market-wise a diamond in the rough or a lump of coal? There is a potential for a turnaround with the founder returning to the helm, but the risks are surely much greater, right? Looking at a stock that's trading at 80 cents, it's kind of like saying, is it going to rain today? You know, that kind of thing. Well, depending on what climate you're in, maybe if in the desert, it's a fairly easy call, but not if you're in the subtropics like I am. So let's turn our attention to a different stock here. So market-wise, not a fan. And that is EverQuote, a company that's been on quite the roller coaster as well. Not a penny stock, it's trading at $22.50, yay, but it has seen better days. And we want to see if this is the gold dust that we're looking for. In 2020, EverQuote was riding high at $60 a share, then dropped to $5 at the beginning of this year. Now it's back to $22.40. So I'm recording this, so it's quite the story. So what's going on here? So what's the story here? Well, they're essentially a matchmaker for the insurance world. They connect insurance shoppers with providers focusing on auto, home, life insurance. It's kind of like the dating app if you are trying to find not your soulmate, but the perfect insurance policy. I know, romantic. So what's going on here? Well, their revenue has been growing quite nicely of late. So from 2023 to this year, the revenue is up something like $40 million, which is pretty substantial, but it's still below the 2022 highs when their business was really booming. But here's the real plot twist. After a history of losses for many years, EverQuote has recently turned profitable. In their latest quarter, they posted a net income, that's real profit, of $6.4 million. So they finally cracked the code to how to actually make money. Their secret weapon, it's kind of the sort of flexible business model. They can adjust their marketing spend based on market conditions. So it's kind of like a chameleon changing colors depending on the environment. When the market's hot, they ramp it up. When it's not, they can quickly pull it back. But of course, the insurance market is a pretty crowded space. They've got lots of competition from traditional and online brokers. So is EverQuote the next big thing in insurtech, or is it just another digital middleman? I would say the jury is still out. I think the revenue up 72% year on year, profits up 148% on last quarter, and actually making some money is pretty impressive. But operating margins are 5%. So you still got to be like, yeah, okay, they're doing well. They're beating expectations again and again, so the market likes it. But is it what I would put all my money in? No, for sure not. As a small gamble, if you like that kind of insurance digital space, it's certainly got the momentum going for it right now. So there might be something in that. Not a terrible play, but also not the top of my list. Now let's embark on something completely different here. NerdWallet. Since its IPO in 2021, NerdWallet has been on a pretty crazy wild goose chase. It's soared to 23, then to 28, then it plummeted to 8. Now it's hanging around $12. So what's the X that marks the spot for NerdWallet? Well, NerdWallet is sort of the wise old sage of the internet, guiding lost souls through the treacherous waters of personal finance, credit cards, banking, loans, mortgages, you name it. They basically got some advice on it. Their revenue has grown very nicely from just under 100 million in 2021 to now about 150 million in the last quarter. Pretty decent growth. But the real gem, it's the user base. They have something like 24, 25 million monthly unique users, and that's pretty impressive. How do they do that? It's a clever business model, really. So they make most of their money through affiliate marketing. When users sign up for financial products to their site, NerdWallet gets a share of the booty. It's like they found sort of a way to find treasure without having to do all that much. And what's the problem with it? Well, lots of competitors, or pirates out there, who are basically trying to do exactly the same thing. And that's really why the stock price has been quite unpredictable, I would argue, because it's promising, sustainable growth and so on. It's quite impressive. But the jury is out whether there will be kind of one dominant player that just takes over search results and dominates everything, or whether companies the size of NerdWallet are able to compete. Now, next is a company whose software I actually use, and do I love it? No, I don't love it, but I often find that software I don't love becomes the most popular software out there, so I thought I'd include it. Asana. They are, well, trying to tame the workplace chaos. It's currently trading at $13, and it's been pretty volatile. They peaked at $145 in 2021, then plummeted faster than a squirrel being chased by Winston, and they're not hovering around $13, which would make most investors rather nervous. So what's the grand plan here? Well, they're essentially selling digital sticky notes on steroids. So they provide work management that helps you track and organize teams and manage tasks and so on. And they do that pretty well. And I know loads of people who use it. We actually use it for one of my businesses. I'm not a huge fan of it, I must say, but I'm not a huge fan of looking at task lists at the best of times. So let's look at their numbers. Revenue is growing, up 19% year over year. Net income is up 36%, which is profit, but it's still minus 250 million, which is quite a lot when you're only bringing in 650 million. So how do you burn through that much money, you got to ask yourself. And then you look at the balance sheet, and let's look at the balance sheet. So they've got some cash. They've got about 519 million. That's only dropped 1% over the last year, which is quite healthy. But do they have free cash flow? Yes, they do. So that's the secret how companies like this survive. Even though they're losing money, because people prepay for the service and it's a subscription thing, so you keep prepaying, they actually generated 78 million in free cash flow this year, which is 3,000% increase. Once you generate positive free cash flow, it's much, much less likely you go out of business. So my rule of thumb for growth companies is avoid them like the plague at the beginning, and once they start making free cash flow, that's where we get quite interesting. Now, Asana isn't the only player in this game, right? There are plenty of tech giants and nimble startups that are trying to get their way into this space. Monday, for example, is a software I actually think is much, much more user-friendly. Monday.com is another stock that's listed. So there are a lot of fish in the sea here. So I would be cautious with something like Asana. I think it's a little too small right now. Let's just see if they can turn that minus 250 million for the year into something a bit more sustainable. And if they do that, then I think we might well be back on this. But last quarter, they lost 63 million. So while generating free cash flow of 25 million. So I'm a little bit cautious on this one here. Now, there's another company that I actually quite like and have used probably for about 15 years or so. It's called Upwork. Upwork provides freelancers to businesses and vice versa. And they soared to like the $60 mark in 2021 and then plummeted faster than a lead balloon and are now trading just below $10, which is pretty shocking stuff. Now, I've never really understood why these guys are not making any money, because you'd think that if what you're selling is outsourced freelancing, maybe with a team sitting in a country with lower cost than yourself, how the heck are you not making money? Now, they have, for the first time ever, I believe, actually turned a profit this year. 46 million on 689 million in revenue, which is quite impressive. So they're out of that zone of being a loss maker, and this is why I included them. And they're doing that while growing quite nicely. 14% increase in revenue just in the last quarter while cutting expenses. Profits are up 650% on the last quarter. So they're actually generating money for shareholders, which is exactly, of course, what we like to see. I think it's a huge business potentially. The whole kind of global outsourcing thingy, you need a middleman that handles payments and legal and reviews and all that kind of stuff. And Upwork bought elance.com a few years back to kind of get a bit bigger and be able to compete. Now, the problem, of course, is that there are lots of small competitors springing up everywhere. And the smaller, medium-sized businesses that use this, and I suppose I fall into that category. Yes, I'm wearing shorts. I wear shorts and jackets. will switch to the cheaper platforms. And Upwork is getting to a point where it's becoming quite expensive, particularly for freelancers to use. So the challenge is, can they retain freelancers, and will the contract stay on the platforms, or are people using it like a dating app? Hey, and then they'll talk to their customers directly and their employers directly, and therefore Upwork no longer gets the fees. So that's a little bit what I struggle with, is like, how are they going to survive the desire of people to go direct? Because if you're working with a freelancer for years and you chat with them every day on Slack or wherever you do, then you have their contact. You could just say, hey, why don't we pay you directly? And the freelancer is going to say, great, I get, 20% more or whatever the fees are. So to me, that's the challenge here. So I'd like to see maybe another quarter or two of that profitability come in and see that they can maintain the revenue growth at the same time. If they do, then I think this could be a real hidden gem. But until then, I'm a little bit cautious on Upwork. So what have we looked at here? Well, take some of the companies like Mankind have shown promising recoveries. Others like MarketWise are still finding their footing, but with the founder coming back, that could be an interesting story to watch. And remember the human element. Like a CEO can be the secret ingredient to a struggling company. Poor leadership can sink the whole thing. So predicting stock performance in the long run isn't easy. If you look at established large players, yes, you can look at gross margins and return on capital and that kind of stuff. But if you want those 100x returns, you have to fish in the slightly more volatile, smaller stocks and companies where those really high returns are in theory more possible. And because small companies grow faster than big companies. But you therefore also take on more risk. And my goal here today was to kind of illustrate that with some companies that look shiny on the outside, but aren't always that shiny once you dig a little bit deeper. And I hope that gives you some insight and some education and makes it a little better for you to actually select stocks. Of course, do your own bloody research. Don't just take what I say for granted. Just because we are up like 90% on our trading portfolio doesn't mean that we're right on every stock we pick, right? We have losing trades. If you want to see some of my losing trades, I'll share them with you, but I also show you the strategies of how we achieve our returns. Then come and join me. Link is down below. Next Tuesday, we're running that live trading training. It's completely free of charge. All you got to do is sign up for it. And remember, investing isn't about getting rich quick. If that's your goal, you're very likely to lose money. You've got to make informed decisions. You've got to manage risks and have rules around that and play the long game. Whether you're a trader or whether you are a long-term investor, ultimately, it's still a long game. And I hope some of what we provide here gives you some useful information. If you enjoyed the video, you know what to do. Smash the you-know-what. And I hope to see you on the next one. Imagine waking up in the year 2040. The world around you is barely recognizable. Autonomous vehicles zip through the air, robots walk alongside humans, and artificial intelligence has become an integral part of our daily lives. Now picture this. In this future, two companies stand at the forefront of this